Welcome to the SMSF Association's webinar for trustees. In this session, we're going to have a look at some of the answers to 10 questions that SMSF trustees of SMSF should ask their financial advisor. My name is Chris Morcombe. I'm a Director and Private Client Advisor here at Hewison Private Wealth. And I've been advising clients for nearly 20 years. I hold a Certified Financial Planner designation, and for many years have held the SMSF Association's Specialist Advisor designation. Our firm specialises in providing initial and ongoing advice to our clients, many of whom have self-managed superannuation funds as part of their overall wealth creation and protection strategies. So the first question that you really should be looking to ask your advisor is about their qualifications. Your advisor should be appropriately qualified. Now, the Financial Advisor Standards and Ethics Authority, otherwise known as FASEA, they now require financial planners to hold a minimum relevant degree qualification. That's going to be phased in over the next 4 or 5 years. The Financial Planning Association suggests that advisors should attain the highest global designation available, specifically for financial planners, being the Certified Financial Planner designation. The SMSF Association accredits financial planners with appropriate knowledge and experience in advising on SMSFs via its SMSF Specialist Advisors designation. And I would, particularly if you're looking at setting up a self-managed superannuation fund, then I'd be, or you've already got one, I'd be looking for someone with that SMSF Specialist Advisor designation as a minimum. A common thread among all of the above qualifications is that there's a requirement to be having been accredited. So there's a testing a component to that and an education component, as well as the need to continually complete ongoing annual continuing professional development. The next issue that we really need to look at is the experience that your advisor has. We're talking about your retirement or savings. You've worked very hard to accumulate your wealth to put in a self-managed super fund, or you're still working and wanting to make sure that the strategies you're putting in place are going to build your wealth. You want to make sure that you're talking with someone who's got experience in advising clients in that matter. So it's important that the person you're dealing with has experience with people like yourself. So if you're a retiree, then you want to know that you're or you're just about to retire, then you want to make sure that your advisor has experience in advising clients like you. If you're a small business person looking to buy a business premises through your self-managed super fund, then you want to make sure that your advisor has experience in giving advice to clients like you. The next one we want to have a look at is the legal requirement for your advisor to be registered with the Australian Securities and Investment Commission, which is known as ASIC. You can look up your advisor on the ASIC register via the ASIC website, and that register will show who your advisor is licensed through and their history of any compliance issues, if they have any such history. You should also ask your advisor for a copy of their financial services guide. This provides you with standard information about the services that are being offered and the way in which the advisor charges for those services. It's really important for SMSF trustees to do their due diligence. Self-managed super funds cannot access the Superannuation Complaints Tribunal for redress if they lose money through poor investment advice or a dud investment. So So really, it's important and incumbent on self-managed super fund trustees to be doing their due diligence to make sure the person they're dealing with is a licensed advisor, is of good fame and character, and has, as I mentioned earlier, the necessary qualifications. And the final point around, I suppose, the advisor's capabilities is whether they've specialising in any particular area. As a rule, most financial planners tend to be generalists in the main, with maybe a few specialisations in some areas. You should make sure that you're dealing with an advisor who has the requisite specialist knowledge to assist you. There's not much point going to an investment specialist when what you really need is high quality insurance or specialised insurance advice. So really make sure and ask the questions to make sure that your advisor has the necessary skill set and specialisation to help you out. Now, one of the key questions that self-managed super fund trustees should ask their advisor is about the charges and how much the advice is going to cost. Now, this information should be spelled out in the financial services guide, and it's important that all the costs associated with the advice, both what it's going to cost up front but also ongoing, need to be clearly disclosed. The fees should be understandable. You should be able to easily understand what the advice is going to cost you, both in dollar and percentage terms, and generally you're going to be paying more for more complex situations. Whereas, and I think the greater the funds that are at stake, the greater the risk level that is attached to that for the advisor providing that advice, and generally you'll find there's more higher costs for greater amounts of money as well. But that's a general rule. It's not across the board. Now we come to one of the key aspects that is actually a bit of a focus of current legislation and the regulators, and that is that self-managed super funds are not for everyone. There are costs associated with the establishment and ongoing management of an SMSF. Your advisor should consider your wider financial planning objectives to ensure that an SMSF is appropriate solution for your needs. The advice provided by your financial planner should be presented in a statement of advice. This document should set out your wider financial planning strategy, and it should include detail about how your self-managed super fund is going to be used to meet your financial and life goals. In my view, the advice should be tailored to your needs, your current situation, and your life goals. It shouldn't, specifically when you're setting up a self-managed superannuation fund, which is a very personalised and tailored structure just for you, the advice that is attached and surrounds the use of that self-managed superannuation should also be tailored for your specific needs. Now, legislation requires your self-managed superannuation fund to have a documented investment strategy, and that strategy is also required to be regularly reviewed. The strategy needs to take into account a number of things at a statutory level. It needs to make sure that all of the circumstances of the fund, both including the liquidity, which is the need for cash as and when those needs arise, is taken into account. It needs to take into account the needs of members, whether they are accumulating funds to fund retirement or whether they're already drawing pensions, and whether the members have a different approach to the investment risks they are prepared to take. The strategy also needs to consider issues such as risk and the return that's going to be required to meet members' objectives, and also the appropriate diversification of investments for the self-managed superannuation fund. This is really important for those thinking about using a limited recourse borrowing arrangement to purchase an illiquid asset such as a property. If you're going to undertake such a strategy, you certainly must make sure that your investment strategy for your self-managed superannuation fund takes into account what you're going to be doing with the fund, but also as a trustee, you need to make sure that this strategy is going to work not only in the first year, but in multiple years as well. It's important for trustees to understand who will implement the investments and who will monitor the self-managed fund investments against the documented investment strategy. And this ongoing role is really important. If you don't have any monitoring, you can end up in a situation where the super fund's carrying more risk than had originally been intended, or conversely, it could end up having more cash sitting in the bank account and not being invested, and therefore you achieve lower returns than what you were targeting. So it's not a set and forget strategy, and as a trustee of the self-managed super fund, you've got an obligation to be reviewing the performance of the fund's investments against its documented strategy. Another key part of the investment strategy is the need for that strategy to consider the insurance needs of members. Your financial planner should be considering such issues, such as the amount of insurance that you require, what types of policies are required and from which insurer. And also, and this is a really key aspect, who should own the policies. So generally, life and total and permanent disablement insurance can be owned by your self-managed super fund. It is also possible to hold salary continuance or income protection insurance via your fund. There are technical issues to be considered, and your financial planner should be able to assist to ensure that the self-managed fund is paying premiums for the right policies and that claims money will end up in the right place when a claim or if a claim occurs. This is a specialist area that your SMSF advisor should be able to help you with, and it can be a way to optimise the cash flow of a person, particularly when they're accumulating, to use their self-managed super fund to pay their some of their insurance premiums. This next question is, in my view, one of the most critical things for retiree and pre-retiree SMSF trustees and members to consider, and you need to have a really strong understanding as to how your self-managed fund is going to be able to fund your income needs when you're not working anymore. Because let's face it, that's what superannuation is all about. So your SMSF strategy should allow, as retirees, should allow you to draw a pension from your cash account of the SMSF, so that you're not being forced to sell assets to fund your income needs. And this is one of the key benefits of an SMSF over alternative retirement products such as unitised pension funds. In the latter, we see the sale of units each month to pay each pension payment, which can lead to a capital drawdown in times of market weakness because you're having to sell more units to fund the same dollar amount of pension payment. As the market recovers, a much higher rate of return is required to recoup the capital lost from those sale of those assets. An SMSF, on the other hand, can have cash in the cash account and income earnings from the investments replenishing that cash account, so that pension withdrawals from the cash account are coming from cash and not the sale of assets. The key to such a strategy is obviously making sure that your investment strategy, your documented investment strategy, is appropriately constructed to provide reliable cash flow to meet your needs, and the investment strategy is monitored to ensure that it remains relevant to the members' needs over time, particularly as members age and their pension requirements increase. The final tip to ask your financial planner is about the impact your SMSF is going to have on your overall estate planning arrangements. Self-managed superannuation fund benefits, like all superannuation benefits, are not an estate asset of the member and therefore cannot be dealt with by the member's will. The advice provided by your advisor needs to consider the member's circumstances and estate planning objectives. It also needs to consider whether the death benefit lump sum or the payment of a reversionary pension is appropriate. This should be considered in the context of the members and their spouse, their respective transfer balance account position, and both the short and long-term taxation implications of the outcome. In addition, your financial planner should also be providing guidance to the trustees and members as to whether a binding death benefit nomination is appropriate, or whether it is better to leave the decision about the payment of death benefits in the hands of the surviving trustee. Estate planning is a complex area, and it does need specialist and advice from someone who is experienced in this area. And if your advisor is not experienced in this area, then it might be worthwhile, but perhaps you're happy with their advice around investments, you may wish to consider getting external advice from an estate planning solicitor who's experienced in the use of self-managed funds to help you craft your estate planning arrangements so that they achieve the outcomes that you are looking for. So that brings to an end today's short webinar and the 10 tips. I hope you found the information that I've presented today of some value. As always, these presentations are general advice only. They certainly don't take into account any of your personal objectives or financial needs and situations. So before you make any decisions, I would certainly encourage you and insist that you go and seek appropriate professional advice. Thanks very much for listening.